Did your investments look great this month? Then one scary headline made you want to sell everything? That feeling is common in 2026. Markets hit new highs, then you remember past crashes. The 2008 crash. The 2020 drop. The 2025 rate shock. The problem is not the market. The problem is what panic makes people do at the wrong time. So in this video, I will share 5 investment moves that can change your life forever. These are not get-rich-quick tricks. These are decisions that protect your money when prices feel high, and also keep you growing for the long run. Each move comes with a trade-off, because every smart choice does. Your job is to pick the move that matches your goal, your timeline, and your stress level. Let's begin. 1. Take some profit, then invest into safer income options. This move is simple. If your investments are up a lot, you take a small portion off the table. Not everything. Just a controlled trim. That trimmed amount goes into safer places like high-quality bonds or money market funds. This can change your life because it creates peace of mind. When part of your gains are locked in, your future does not depend on short-term market moves. You reduce the risk of panic selling during a sudden drop. You also create a stable pool for near-term goals like a home purchase, education, or career changes. This move works best when a goal is approaching. If you need money soon, full exposure to market swings can be dangerous. Stability matters more than squeezing out extra growth. The trade-off is real. If markets keep rising, you may feel left behind. Safe yields can also change over time. But the purpose here is protection, not perfection. A smart way to apply this is a rule. Example: if an investment grows beyond my target, I trim 10% or 20% and move it to my stable bucket. Rules reduce emotion. Emotion is what ruins timing. If you want one action today, look at your portfolio and pick one goal with a clear date. Then decide what portion must be stable for that goal. Move that portion out of growth mode and into sleep at night mode. 2. Rebalance your portfolio away from heavy tech exposure. When markets are hot, the gains often come from a small group of stocks or one popular sector. In many recent rallies, big tech led the charge. That can be great while it lasts, but it creates a hidden danger. Concentration risk. If one part of the market falls hard, your whole portfolio can get dragged down with it. This move is rebalancing. You reduce the area that grew too large, and you add to areas that became too small. You keep your portfolio balanced across sectors, styles, and regions. You stay diversified on purpose. This can change your life forever because it keeps you in the game for decades. Most people do not fail because they chose the wrong investment. They fail because one part dominates, then a correction hits, and they panic sell at the worst time. Rebalancing lowers the odds of that nightmare. It also builds a strong habit. You stop chasing what is hot. You stop thinking this time is different. You start managing risk like a pro, even with simple choices. Now the trade-off. If the crowded winners keep running, diversification can look boring. You might feel like you are underperforming friends who went all in on the hottest thing. That is the cost of risk control. In the short term, being balanced can feel slow. In the long term, it often helps you stay consistent, and consistency wins. A practical way to do this is a schedule. Quarterly or twice per year. You check your target percentages. You rebalance back to your plan. You do not do it every week. You do not try to predict news. You just follow your structure. If you want a simple example, think like this. I want 60% stocks and 40% safer assets. If stocks run up and become 70%, you trim back towards 60%. If a crash happens and stocks drop to 50%, you add back towards 60%. That second part is what changes lives. Rebalancing forces you to buy when you feel scared, and sell when you feel greedy. Most people do the opposite. Action today. Write your target mix on one line. Then check your real mix. If you are far off, make a small step back toward balance. 3. Turn part of growth into guaranteed income for the future. Some investors want more than growth. They want certainty. Predictable income. Confidence that money will last. This is where guaranteed income tools like certain annuities can help. This move can change life forever by turning market gains into dependable cash flow. It reduces fear around retirement timing and market drops. It also helps cover basic living costs regardless of market noise. When income is predictable, planning becomes easier. You can separate essentials from lifestyle spending and invest remaining assets with less stress. The trade-off matters. These products often reduce flexibility. Money may be harder to access later. Fees and rules vary, so understanding details is critical. Using this move wisely means layering. One layer for income stability. One for growth. One for emergencies. No single product does everything. Action today. List your future essential expenses. Ask which part of your plan covers them even during a market decline. If the answer is unclear, this move may matter. 4. Sell a portion now and invest back slowly over time. This move is for people who feel nervous at high prices, but also know that staying invested matters. Instead of going all in or all out, you create a middle path. You sell a portion now, then you reinvest that portion slowly over time. Weekly. Monthly. Over 6 months. Over 12 months. This is averaging back in. This can change your life forever because it breaks the habit of emotional timing. You stop trying to guess the perfect top. You stop waiting for the perfect bottom. You give yourself a plan that continues even when your mood changes. It also helps your sleep. If markets drop after you trimmed, you will feel relief instead of regret. If markets keep rising, you still participate because you did not exit fully. You stay connected to the market, but with less stress. Now the trade-off. Discipline. Averaging back in sounds easy until the moment arrives. If markets rise fast, buying later feels painful. If markets fall, buying feels scary. That is why the plan must be written before emotions hit. Here is a simple way to apply it. Step 1. Pick the amount you are trimming. Step 2. Pick the schedule for buying back in. Step 3. Automate the purchases if possible. Step 4. Do not change it because of headlines. This move also works well when you receive a lump sum. Bonus. Sale of an asset. Inheritance. Instead of dumping it in all at once, you average into the market to reduce timing risk. Action today. If you feel nervous, do not let that fear control you. Convert that fear into a plan. Decide one amount you can trim, and one schedule you can commit to for buying back in. 5. Do nothing, because your plan is already working. This move sounds boring, but it is often the most powerful. If your portfolio is diversified, aligned with your goal, and built for your timeline, doing nothing can be the best decision you make. Why can do nothing change your life forever? Because most people destroy wealth by overreacting. They sell during drops. They chase during hype. They jump in and out so often that they miss the best market days. Then they blame investing, even though the real problem was behavior. Staying the course builds a rare skill. Patience. You stop treating the market like a daily vote on your future. You treat it like a long road where bumps are normal. Now the trade-off. You must tolerate the next correction. And it will come. That is not a prediction. That is how markets work. If you cannot handle drops emotionally, do nothing becomes hard. So do nothing only works if you did the setup correctly. You must know your risk level. You must keep emergency cash outside your investments. You must keep money you need soon out of risky assets. You must stay diversified. If those pieces are in place, the best move in a noisy moment is often to keep going. Keep investing. Keep rebalancing on schedule. Keep living your life. Action today. Ask one question. If the market drops 20% next month, will my life change? If the answer is yes, your portfolio may be too risky for your timeline. If the answer is no, then you may not need to touch anything. Markets going up can feel exciting, but they can also mess with your head. Your goal is not to win every week. Your goal is to build a plan that survives crashes, boredom, and loud headlines. Pick the one move that fits your life right now, then apply it with calm action. If this helped you, hit like. Share it with someone who keeps stressing about the market. And subscribe, because the next videos will help you build a money plan that actually works in real life. Thanks for watching. I shall see you in the next video.